Meta finalizing its deal with Scale AI, investing $14 billion and hiring the company's CEO, Alexander Wang. Meta will have a 49% stake in the artificial intelligence startup. Joining me now, we've got Gil Luria, who is the D.A. Davidson head of technology research. So, Gil, just take us into your assessment of what this means in effectiveness for Meta and their own ambitions with AI.
This is unbelievable. It tells you that Mark Zuckerberg thinks that having one of the most competitive AI models is the most important thing right now. Making a $14 billion investment, not to even buy a whole company, but just to have the head of a company head up your AI effort is remarkable, even for somebody as aggressive as he has been. And we're also hearing that they are making 8- and 9-figure offers to AI engineers. And what's even more remarkable is that some of those engineers at OpenAI and Anthropic are turning it down because the value of their stock in those entities is higher than that. So it tells you how important this is to Meta and how far behind they feel they are right now.
And so, as we're looking to how immediately accretive some of these efforts will ultimately be to Meta's business, what should investors be keeping tabs on how the company is talking about the roadmap and how these features will ultimately play out in some of where monthly and daily active users already engage?
So the investment in the core science, which is what this is about, will not bear fruit anytime soon. But what does happen with Meta is they are able to use better and better AI technology to sell more ads, to sell those ads for higher prices. And that's how they can justify their very high rates of investment. They're investing almost as much as Google, Amazon, and Microsoft in their data centers and in their AI effort, not just because of their importance on having a great AI model and being one of the best frontier AI models, but also because it makes their core business better. And that's how they're justifying it and why it's been improving their results for the last few quarters. They've been able to have high teen growth rates in their ad business, which means they're gaining share from Google, really, because they're selling more ads and they're selling them at a higher price.
While we have you, Gil, I want to switch gears, talk about a company that just reported earnings after the bell yesterday, and we're tracking shares of Adobe. They're still slumping just a little bit here. We're taking a look at some of the actuals versus the estimates, beat on top and bottom here. What do you think it is that investors are still hung up on right now?
So investors are ignoring the fact that Adobe has had great results yesterday and for several quarters. They've actually been one of the most resilient companies over the last few years in terms of handling very different types of environments. Investors are really just preoccupied with the impact of AI and Adobe. And we believe that have wrongly concluded that Adobe will not do well in the new era of AI. We believe it is quite the opposite, which makes Adobe probably the best value in all of software, maybe the biggest dislocation of software, because we see them benefiting from AI as they integrate these newest models and image generation and video generation to their product, not a victim of AI. But that's the controversy in the market right now, and that's what creates this opportunity.
And so how much more margin do you think they could really accelerate in terms of bringing shareholders even more value by showing that they're able to be a more profitable company and increasing the profile of their own profitability given the additive of AI that they're layering in to these services?
Yeah, that's exactly what they have to prove right now. And yesterday on the call, they talked about believing that they not only can continue to grow this business by 10% going forward for years, but also expand margins from an already best-in-class 45% operating margin level. So that means double-digit earnings growth for years to come. There's very few software companies at this scale that can say that, and they just confirmed that last night.
All right, you have a buy rating on the stock and a $500 price target. We'll continue to track how Adobe does. Lastly, while we have you, Gil, because you have quite the coverage universe here, I got to talk about and bring up Microsoft here this morning. And of course, slumping just a little bit. The broader markets are pulling back, given some of the tensions in the Middle East. And of course, that naturally throws a wrench in some of the recent highs that we've bumped back up against. But for Microsoft here, what's core to the driver that is really going to have investors swooning over this stock for years to come?
Yeah, so Microsoft is offense and defense, right? In terms of their core business is the enterprise business. That business is going to be much more resilient than a consumer business that may be impacted by any shifts in the economy or disruptions to the economy. So that makes them the most stable of the mega caps. But then there's also offense. They have the fastest growing hyperscaler. Azure grew 35%. They're growing so fast, they have to offload demand into smaller hyperscalers. They are at the center of what's happening in AI. They have been for a couple of years. They had a little bit of a hitch towards the end of last year, the beginning of this year, but they've reemerged even more victorious. So that's why they're the best performing of the mega caps, and we believe they'll continue to be the best performer.
Gil, I only got about 30 seconds here, but as you're thinking about Microsoft and the mega cap stocks right now, even amid some of the geopolitical tension that we've been tracking and the breakout of even more conflict in the Middle East, does that make some of these Mag 7 stocks even more attractive? As even though it is an overcrowded trade right now, it seems like that is one of the new defensive plays, if you will.
Yeah, Microsoft, Amazon, to a certain extent, Meta, these are companies that are in very good shape, have been performing well, are more resilient, more diversified across several businesses, and have a more limited impact from the consumer than maybe some other stocks or cyclical stocks in the economy. So we do believe that they will be a somewhat of a shelter to the extent that there's even more disruption.
Gil, good to speak with you as always. Thanks so much for taking the time here early, I know, this morning as you're on the West Coast. Appreciate it.
Thank you.